In today's video, I am going to be breaking down my top 5 blue chip stocks right now. This is a whole list. This is actually comprising of a few different sectors as well. So let's get down and let's check these out. So no real big surprise here. I have picked Apple as my 5th best blue chip stock right now. So of course they've had some hurt right now when it comes to their stock price. It's no longer at their all-time high. Their all-time high being 145 and it's currently sitting at 124. It's actually quite a good deal right now in my opinion. They do pay a little bit of a dividend of 0.71%, so a little bit better than interest, but at the same time there are better dividend stocks out there, and we'll be getting to those very soon actually. Their average volume is insane. Lots of people buying and selling this stock. A lot of big companies, a lot of big funds are buying and selling this stock. It is a very big stock. From there, its PE ratio is 28, which when it comes to tech, when it comes to the American market versus the Canadian market, it is roughly okay. In my opinion, it's a bit high though. Their 5-year chart is insane, like it always is. Recently, it's had some sort of a consolidation period, which is totally fine. This is what you want to see. This is the time you really want to buy in, to be honest with you. It's always scary when you're buying on the way up. And the reason why I say that is, yay, you'll be buying here maybe, and then you'll be looking at here and saying, wow, I bought here, I bought here, I bought here, I'll buy more here, and then you go through a lot of hurt, and you might sell here, and then you'll be going up again, and you might buy here, and then you'll be like, oh crap, it went down, you sell here. You don't really want to do that, and that really does look like the Roadrunner, but you generally want to go through and buy at the consolidation periods before the big run. You let yourself hold through the big down phases. Buy when it's consolidating again. We see that here. And then, of course, acceleration hits. And then you can buy at the consolidation, have another little run, consolidate again, buy a little bit more, and it's going to go up even higher. Let's face it, they have a lot of new products coming out very soon, and of course recently, and of course they do raise the dividend quite often. We can also see that they beat earnings estimates all the time. They also had a hell of a good 2020, and of course consistent growth, which is good. Alphabet is the next company. Alphabet does not pay a dividend, which sucks. It would be nice if they did, but they do own YouTube, which is what pays me most of my income. And they do trade at 1 million plus shares every single day, so it's easy to get in and out of, but their PE ratio is even higher than Apple's, but again, roughly on the American market, 25 to 30 is okay. Myself, I like investing in banks, so I always like the low teens, but I guess you just pick and choose. Tech is tech. Again, very great run. 2020 COVID hit, another great run. Is there a consolidation period happening? There might be. It might be a good time to buy in at this point in time. It might be good because we've seen the consolidation here, growth. It looks like the consolidation will be between here and here. Then we'll see growth once again. It's always good to buy in the consolidation periods. They've also had very great growth when it comes to earnings. We can see that here, as well as in their earnings calls. They have been outperforming over and over and over again. And I really like Google mainly because they are investing into the future. Things like artificial intelligence is huge. I think we're going to be hitting the singularity very soon, probably over the next 15 to 20 years. And once we hit that AI, artificial intelligence, general artificial intelligence, once we hit that singularity, the rate of growth is going to be insane. When we start looking at different technologies like CRISPR and things like that, I'll be talking about very soon in videos, these technologies are going to be huge factors into our future, and I think Google is right on the beginning cusp of even where it's going to go again into the future. The third little stock, I'll say a little, but it's a big one. Bank of America, another blue chip that is very good. Banks I absolutely love. If you've been following my channel for any amount of time, then you'll know that I absolutely love their dividends. This is only 3.3%. It's not massive, but they haven't been allowed to up their dividends for over a year now because the government agencies are not allowing them to do so because of COVID. So they are expecting, some analysts are expecting a big 10, 15, even 20% raise in dividend. I am more conservative, closer to the 8 to 15% range. I think that all of the banks will be raising their dividend probably the last quarter of this year, the first quarter of next year. This one does pay a very big dividend, has very big volume as well, which is good. Its next earnings call is August 24th, so that's kind of the earliest point where some analysts think that they'll be able to raise their dividends. Its 5-year chart, just like every other bank, played within a range, didn't do anything for many, many years. Finally, COVID hit. I actually thought that we were in a recession right here. And then COVID hit, which just absolutely decimated. CERB really helped a lot of people, but I think there's going to be some more hurt coming very soon. But that double bottom is very, very good. Anytime you see a double bottom, that's when you want to buy in the second just up. So, like, really quickly, I was buying a lot of banks, and they all did this, where they had that double bottom. And anytime you see that double bottom, anytime you see a very big rebound off of just ridiculous losses, if you can see it come back down and then it bounces off roughly the same point as before, when it's roughly around here, you definitely need to start buying in. And then, of course, there's going to be a big rebound. It's going to cap out. It's going to consolidate for a bit. It may even go down, buy more here, and just absolutely run that ride all the way back up. As we can see, they raise dividends quite often, but again, they have not been allowed to for well over a year now. Usually, Canadian banks will do it either twice a year or once a year, depending on the bank. And of course, they have been outperforming on every earnings call, even quarter 3 of last year, which is what actually messed up a couple of banks. Their earnings growth has been good other than last year, which is no big surprise. CIBC is another one. I really like the Canadian banks. This is actually one of the few that are over 4% dividends, which is good. Again, big volume, very good. I like this. I like dividends. I like volume. Makes it easier to come in and out of the stock. Again, trading within a range. Anytime you see that, it's not a time to buy. It's unless you're just buying it to buy, just hold the dividend. But at that point, you can get higher dividend ETFs. What you're buying an individual stock for is for the growth, and that's what you see here. This was a very big portion of what you're seeing here up until this point. Earnings started to kick in, and it was a lot better than expected, and that's why they're saying, well, it's going huge. And the reason why Canadian banks are essentially going to the moon, just like Dogecoin, is mainly because they have found a way of making money during a recession. They are charging bank fees. I've been saying this for years, even though I haven't had this channel for years, is they will make money no matter what happens. Yes, they make a ton of money when interest rates go up, but they are now figuring out, hey, if we're charging everybody $20 a month or somewhere around there to have a bank account, look at how much money they can make. And then, when it comes to ETFs, they're making even more dough because they're charging an MER. Same as mutual funds. Same thing, just higher MERs. And then, they charge interest. And then, they don't have to give you interest on any of your money because the Canada government doesn't have an interest rate. It's basically zero. So, when they don't have to give an interest and they're holding your money to make more money for themselves, yes, they're going to be making money hand over fist. And this is why I invest in Canadian banks. And yes, if you hold $5,000, $6,000, whatever it is in your bank account, you won't be charged fees. I do that too because the bank fees are outrageous because it's cheaper to actually have the money in the account than to have it not in the account, because if you're looking at $240, $250 a year on $5,000, that's a hell of a lot better than even 1% interest. So yeah, that's why I keep it in there. And again, they've been raising dividends forever, but they haven't been allowed to for a while. They were going every quarter at one point, raising dividends, and then they did it every 2 quarters. So they are a very solid dividend-paying company as well. They also have been outperforming by a ton on the estimates. They also didn't have that great of a 2020, but again, they're still making money hand over fist. They're still on the growth pattern, which is good. And then the last one is a bank, but it's an American bank, Basically, this one pays a 2% dividend. It's always good to be diverse when it comes to banks because you don't want to hold them just in one single country. You want to have multiple country banks that you like. This one just gets traded at millions and millions and millions of shares every single day, which is huge. PE ratio is again 13, which is lower, or at least on the lower end of most American banks. Unlike the Canadian banks, they were actually growing during this time, which is why I was saying, and I always will say, it's good to, if you're going to hold banks, hold multiple different countries' banks, because with Canada, it basically did this during that time, and then when COVID hit, it did this, and then afterwards, it went like this, which this is also going like this. So, this is why I say hold multiple banks. You're going to have growth, consolidation periods with growth, and then you're going to have insane growth every once in a while. The American banks are very similar to the Canadian banks. They can't up their dividend right now, but at the same time, once they were allowed to raise their dividend after 2008, they were able to raise their dividend quite considerably all the time. Like, check this out. 2018 July, 56 cents. July 2020, 90 cents. Literally 2 years later, and they have pretty well doubled their dividend payments. This is why you want to be diverse, not just in one sector, but through a lot of different sectors. They've also been beating estimates, just like the Canadian banks. They were also growing before 2020, which is, again, just like the Canadian banks. But overall, these are my 5 different blue chip companies that I really, really like. Amazon is another good one, but it's more tech, but also retail. But again, another great stock is Amazon. I hope that you've enjoyed today's video. Make sure to hit that like button, subscribe. I'll see you guys again next time.